Good evening, good morning, good afternoon, depending on when and where you're listening to this call from. My name is Nicholas Conti, junior trader here at King Visions Forex, otherwise known as Pips Over Pass. And we're back again with you guys with another video. Today, we're going to dive into candlesticks. We'll be looking at the dichotomy of candlesticks and seeing how we can take this knowledge and make us more proficient in our trading. So without any further ado, we'll jump into candlesticks. First up, we're going to have our candlestick breakdown. We'll be taking a look at what is a candlestick. Now, a candlestick, also known as a Japanese candlestick, is a style of financial measurement used to describe price movements of a security, a derivative, or a currency. Now, each candlestick typically shows 1 day, thus a 1 month chart may show 20 days of trading, 5 days in a week, 4 weeks, or also 20 candlesticks. Now, candles can tell us information about the supply and demand relationship between price. Multiple candles form a pattern or a story, giving us a overlay or overview of what price is searching for, or general areas that price may revisit or visit. Now we're going to be breaking into and looking to the candlestick anatomy. With a general candlestick, we're always going to have right about 5 different portions. We're going to have a open, a high, a low, a close, the spread, or the actual body of the candle, and then we want to have that range that the candle or the spread was contained in. We got a couple of diagrams here to break this down for you guys. So first we have the opening of the candle. The open is going to be where price tells us where buyers and sellers agree the start of that period or that candle. Now, the change from the close of the previous candle could be an indication of sentiment. Just a brief FYI, guys, feel free to go back to our gap introduction, our gap lecture, and you guys can understand how the changes from the previous close to the most recent candle can actually give us an indication to where price may go. Next up, we have the close. Price tells us where the balance point was at the end of the period, the last agreed price between the buyers and sellers. Now we're going to be looking at the high. The high is going to be the highest point to where the instrument traded during that candle, the highest point that the bulls were able to reach before the sellers regained control and pushed the price back down. The high shows potential strength, or excuse me, the potential stronghold for the sellers and a resistance area for the buyers. Next, we do have the low. The low is the lowest point the instrument traded in that candle or period. The lowest point the bears were able to reach before the buyers regained control and pushed price higher. This could represent a stronghold for the bulls and also a support area for the sellers. Now, in between the two, we're going to have the spread. The spread is the difference between the opening price and the closing price. When the difference is moving in a positive direction, it shows us an increase, aka demand. When the difference is negative, it shows us a decrease, aka supply, or a increase in the actual supply. Now, this actual diagram or picture here is going to give us some relativity, or going to show us a example of the range. Now, if we look at the example here, the actual price between the close and the open, or excuse me, the actual low and the high would be the actual range. So from the low to the high is how we determine the range of that particular candle, no matter if it's going to be a 15-minute chart, hour chart, daily chart. The full high to the low is the range of that particular candle. Now we jump into reading the candlestick. So I got a couple of steps here for us. First step is we want to actually take a look at the size or the spread, aka the range of the candlestick from the open to close. And pardon me, it's actually going to be just the spread, not the range, but we're going to be looking at the spread from the open to the close. Now, just a little FYI, little attention notice, every candlestick has the same amount of buyers and sellers. A lot of times That's not information that's just put out there. It is important for us to know that there are always equal amounts of buyers and sellers in the market. Now, the only reason for the bar to go up is going to be if the buyers were committed to one direction more aggressively than the sellers. The reverse will be true for the bears or for the sellers if they have widespread candles. Now, candle spreads, aka the bodies, uh, what they actually show us is the move of price and the potential strength in that actual candle period. So the bigger the extension, generally the potential for more strength in that actual candle. Dive into a little mock-up chart here. Have some examples of 3 different bodies or candle bodies that we like to consider. We're going to have a wide candle here, an average candle here, and then we're going to have a narrow candle here. Each one of these candles are going to give us different visual data or representations of things that price could do or what price is actually telling us at that current period. Now, the candle spread does show us a lot of information. We see a long body here, it does generally show us strength in that actual candle. Now, when we see consecutive candles becoming longer, it shows an actual momentum. So we may have momentum coming to the downside here. Now, the candle spread shows, once again, it shows a lot of information. This is just showing you guys an overall example of market flow. So we see we have the long body inducing the strength, and we got an actual push up. And then we see the 2 consecutive bodies, and we are able to visualize or see the rollover that happens in the market. Now we have the narrow candle here. We show multiple small candles. It also identifies momentum weakness, i.e. giving us that potential for the rollover. Now we're diving into more diagrams and examples of what it actually looks like as you see different examples on the screen. You see the small bodies coming into a resistance zone, causing that rollover or showing the momentum weakness. Then we get our move down. Same effect on the latter side. We have a support built. We have support coming in with smaller bodies than normal. We actually even have, I gave you guys an example of the momentum shift, or some people like to call them shift candles. Start seeing the average to wide type of bodies signaling that the momentum shift, and we do have the move up. One of our second steps here we like to take when we're considering or we're breaking down performance surgery on the actual candlesticks, we like to look at the length of the wicks, furthermore hinting the anatomy of the candle. Now, the length of any wick, either to the top or the bottom of the candle, is always the first point of focus. So we like to look at the high, the wick first, because it instantly shows us the strength, the weakness, and indecisions that's going to be shown in the market by investors, hedge funds, i.e., aka smart money. Now, larger wicks show that the price has moved a lot during that deterioration of that candle, but it got rejected at some point. So, or it got rejected at that actual point. It shows presence of a supply and demand factor. Lower wick acts as a support, and an upper wick is going to act as a point of resistance. Now, this is a little chart, a little diagram we like to take a look at. It's going to be a body to a wick relationship. So as you guys can see, these kind of long, stretched out wicks are telling us a story. It's giving us the dichotomy of the market, understanding of what actually happened in that candle. So we always hear King Visions, we like to approach the market with a top-down approach. If you guys do take a notice, I'll read off some of these actual guidelines, but if you guys take a notice here, we can say, for example, this was a daily chart. Well, these lines are showing the movement in between that chart. The markets are always fractal. Fractal meaning that what happens on one time frame eventually moves over to the higher time frame. So what we had was the candle open. We had the candle form the low, i.e. smaller time frame, hour chart. This is what it'll look like. So we had a reversal there. Let me rewind this. I had some technical difficulties with my mouse. Pardon me. So we can use these example as, say, the first actual candlestick there is a daily chart, 4-hour chart. The one to the right is going to be a smaller representation. Once again, the charts are always fractal. So you can look at these little line graphs as more of like a 15, a 30-minute chart. And they actually help build the daily chart because the markets are fractal. So price opened and drove low and closed near a high retracement, more than 70% of the move, which means that sellers tried to sell it, but they failed. Buyers entered, changed the sentiment, changed that counter to bullish, or they rejected that actual price level. And this is actually a nice entry signal that we'll go into here later in the call. And the next one here was going to have price open and drove down. It closed the middle of the candle, which for my Fibbo guys, that was a 50% retracement or below 70. That actually is going to mean that the buyers enter, but sellers are still in more strength. It's actually like a neutral zone. Same thing here. We can see what a smaller time frame chart would look like. So that's one thing I want to highlight is you guys to start looking at a multiple time frame approach, learning how to move through multiple time frames, working top down, also from the bottom to the top. So it gives you a more perspective of what price is doing, and allows us to eventually be able to build out these next candles on the higher time frames. So we have the next one. We're going to have a price drove down and closed at the low of the candle. Price only retraced about 30% of the move, which means that it's a strong bearish sentiment. Next one is going to be one of these little odd boys here. We have the high, the open, the lows, the close. A lot of different movement here. A lot of indecision, a lot of, i.e., I hate to say the term, but a little bit of consolidation on a smaller chart. Now, price opened up. It drove up, setting a high. It got rejected by the sellers. Then it drove down, got rejected from the buyers. It drove up. Price open and close are near the open price. This actually, it actually shows us indecision in the market when we see candles like that. So that's body to wick relation. If you guys do take a detailed look at this, start looking at the candles, like I say, work your way from top down, then come from the smaller time frames to the highers. Give you guys a better visualization of what price is trying to tell you, i.e. the story, and we combine some of those things to make informed decisions in the market. Now we come to a nice signal that the market gives us called a pin bar. You guys may have seen that pin bar on the other chart, that first candle. What happens is we get price that comes up, brings some momentum to an actual resistance zone. Price could potentially break that, and then the sellers come in and push price down at that resistance point. Now, price approaches the resistance with decreasing. In this actual example, it approaches it with decreasing momentum. This next one, price opened up and trades above the resistance. But before the end of the day, the actual bears step in and they take the price back to a lower end of the trading range, creating a small body for the day. The longer wick represents that sellers has started coming in at those levels. So you guys can see examples of the bullish pull pin bar and also the bearish pin bar. We just explained how these actually form on your chart. So there's going to be some great candles to start recognizing and looking at as we approach certain things in these markets. Now, what is a pin bar telling us? Now, a pin bar is a trap by actual institution hedge funds. They're familiar with a lot of the things that's taught. I like to call it retail noise. A lot of the different strategies you see out there, patterns, setups. Of course, these are $1 billion corporations, so they know a lot of the things we do in the market. So we do have to take a thinking outside of the box approach. Pin bars are a great standard for actually entering the market. They're pretty concrete, so it gives us and it shows us the momentum and the formation of general price direction. So we're not guessing, we're not taking a stab at buying into resistance, things of that actual sort. So pin bar is a trap that's usually set for, you know, novice beginner traders. The reason why is those traders are actually, I was just saying, looking for breakouts. They'll buy after they see confirmations. They see and establish, you know, there's a dodge, the trend is your friend. I always like to add the trend is your friend until it ends. But their stop loss orders are usually triggered at the price it moves back down. So all those traders in the market may feel that they're missing out, feel they're pressured to buy because they see, you know, the pullback, the famous buy after the pullback method. So a lot of traders jump into the market. They're on edge to see their pullback, to see the price moving up. They want to go ahead and get into the market. Now they move the price above um, or below any of the reference points, depending if it's bearish or excuse me, bullish or bearish, hitting the actual stop losses of either buyers or sellers, while at the same time they're encouraging traders to commit positions in wrong directions. Now, these institutional hedge funds, they induce traders to take the wrong direction by using sharp and aggressive moves near the high or the low of the day. If you guys have been tuned in to me, some of my regulars, you guys do know we talk about inducements. We talk about clearing the board, how the operator, the composite operator, likes to induce people to buy, also inducing people to sell, which is why we like a lot of these wedge patterns. We get good positions in the market from knowing concepts, not necessarily chart work, but knowing the concepts of some of the moves. We study some of the moves that the big boys are doing. So that's going to be what pin bars are telling us. I have another graph here, another example of some of the way that pin bars set up. You have the move that's going to be enticing traders to take positions, i.e. breakout traders. People are just kind of waiting for the pullback to buy into the pullback. Which I like that method, but there's certain key things that you learn as far as concept wise that'll give you an understanding of when to apply that method and when not to. So clearly this was a downtrend, got a retracement. We want to look at the grand scheme of things, not just this one movement, not bar for bar, but these bars do give us early indications. So we see they break, they set up the traders, then i.e. they pull the market back, running very, very heavily. So they induce traders, then they pull the price back very, very fast in order to hit stops, all type of craziness like that, all type of noise like that. So that'll be another example. Now we're going to go into upticks, up bars, down bars. Furthermore, just kind of slicing and dicing, looking into the anatomy of a candlestick. So we are able to perform surgery on these candles through these markets, through these charts. So we're going to look at the up bar first. If the recent bar closed previously above the prior bar, making higher highs, higher lows, the sentiment is an immediate uptrend at that current moment. If you guys tune in, feel free. We have a actual market structure video on the channel. You guys can take a look at that and learn about the lows, highs, higher lows, higher highs. Once again, it does show the same example. You see the full candles. We can look at these as smaller time frames, building out these daily time frames, pulling us higher highs, higher lows, giving us entry points, entries and exits. Now, an up bar starts an upswing and confirms the end of a downswing, showing us reversals. Now, the down bar, if the recent bar closed below previous bars, making it a lower low and a lower high, the sentiment or the immediate trend is down. Down bar, again, starts a downswing and confirms the end of an upswing. We do have certain structure or formation forming in these higher highs and higher lows. Now we get into understanding the momentum or the strength of these candles. So we see here we have the double momentum. We have the up bar here. We have a nice size, a pretty wide candle. Our average candle here followed by a wide candle. That current candlestick pattern starts to show us the candlestick larger than the previous one, which shows the momentum is increasing to the upside. Opposite end wouldn't say the opposite end, but the next example, we're going to have the current candlestick smaller than the previous one, which shows there is a little bit of hesitation or stalling, or the momentum is decreasing. Now, when we take a look here, we're going to see average candles building upon each other, up bars. We see that the buyers are in control here. They're still in control. They're still in control. Now, when we look down here, we start with the buyers in control. We start with a more of a narrow candle. That narrow candle gives us the first indication. Bam, what do we see next? We see the sellers came in hot. They rejected some of those higher prices. They're starting to take control of the market. Okay, here I didn't want to drag this out, make it too long. This is just a dive into some of the dichotomy of the market. I had a more advanced lecture planned out, but I don't want to drag this out. I want to take in consideration some of our newer members, newer traders in general. So here we're going to dive into some actual charts, and we'll take a look at some of these things we're going over in this presentation. Here we go. Here we go. You guys feel free. You can follow us on all forms of social media at Pips Overpass. We have our Telegram channel here up the top. This is going to be one of the examples that was pictured in the diagram. We have price coming down to a known support area. We see price rejected here. Came back, came and gave us a retest. We got the candles getting smaller once it entered into this foreign place of support. Okay, you may say, how did we know this support? Well, you see market here bounced. We'll act like none of this happened. Market bounced here, came back down, it bounced again. Something's here. Something's pushing the market back up. Usually buyers or sellers laying in wait. Bam, we get it one more time. We see that the candles were getting smaller at this area versus how wide these other candles, average candles, was pushing down. So it signaled here, came up into these next few candles, price action. We're not gonna go too in deep, but we do have a couple of patterns here in these particular candles. Great read on candlestick would be the Candlestick Bible to show you what some of these things like dojis, hammer candles actually mean. We have the momentum candle, or the shift in the actual momentum, giving us further signals. Then we have a nice shift candle, as known by most traders. So we see it pretty much push up out of the zone, come back for a retest, and we're off. We have to move up. You see the actual trend direction. Not a big fan of diagonal trend lines. I more prefer horizontal axis. But hey, 2020's hindsight, once you actually able to see the trend forming, you do see those data points kind of hold true until, say, dun dun dun, we have a rollover here. And we were looking at this example earlier, so we'll start here. We'll look at this actual zone where price started rejecting. It gave us a clear indication. We're going to dive into deeper of some of these things, because you guys will start being able to notice what we call supply and demand. A lot of the winning done in trading is not actually the chart work, believe it or not. It's going to be in knowing some of these concepts like supply and demand, the factors that are actually moving the market. So we see price come down, we move it. We can call it a support zone here, just for purposes of this actual lecture. So we see the support zone hold up, breaks down. We hit the actual trend line, comes back up, tests the actual zone, couldn't break the zone. Bam, we're starting to get the same thing we're getting over here. We got momentum candles. We got a actual up bar or down bar forming, and then we have the nice move down. Very nice trade here. Wait for the move down, come back, give us more confirmation, rejects, give us the nice wick. We see the nice wick showing the rejection. Probably about a 50%, maybe about 45%, but we do know we have the something to lean against. We have the actual support, or excuse me, resistance in the actual market that confirms us to take that entry, give us a nice wick entry, also a nice stop loss. So the beauty about learning some of this dichotomy, performing, constructing some of these methods with the candlesticks, is you guys are going to get sharper entries, very, very sharp entries with tight stop losses, pertaining to what time frame you're actually trading. So nice setup here. coming off of an actual supply zone and a market tank. So those are some of the things. I want to give you guys some live examples on the charts. We'll take a look here. This is even actually a daily chart. So if we want to itemize, let's go over here. Let's do something different to end this call off. Okay, we have an example here. Let's see what we do have an example. Take this candle here. Looks like one of those candles we've seen on the diagram. And if we just simply come down, first let's highlight this candle so we don't lose the open and the close of that day. If we jump down to a smaller time frame, see where it actually started. See all this choppiness, this movement. What I want to give you guys is just an example of how the market flows. Start noticing the flows, the legs of the market. And eventually you get to the point to where you can kind of draw out what the candlestick will look like. So don't want to make this too dragged out. Don't want to go too in depth. It's going to be a starting point for you guys to start breaking down some of these candlesticks and seeing in the actual candlestick, starting to be able to see that the market's fractal. The market tells us a story. And when we couple that with some of these pricing, the numbers, we're actually able to get a bird's eye view. We're able to get a more of a 3D approach to the market, which allows us to be a little bit more efficient, a little bit more direct in some of the places we're actually trying to trade. So once again, my name's Nick, Pips Overpass on all forms of social media. You guys feel free to give me a follow, like the channel, subscribe, leave us a comment if this was anything that was helpful for you. And there's our Telegram will be posted in the description. You guys have a blessed day and stay tuned for more walkthroughs.